Private credit cartels operate outside traditional public banking channels. Alternative asset managers deploy billions in direct corporate lending, bypassing public bond markets and standard regulatory scrutiny completely. Shadow banking institutions provide custom financing solutions for major corporate buyouts. Flexible lending terms allow private debt funds to secure superior yields while maintaining strict collateral claims. By negotiating directly with corporate borrowers, private credit funds enforce strict debt covenants. Superior legal protection guarantees asset control, even during severe economic distress or borrower default. Private credit markets have expanded into a multi-trillion-dollar financial power. Understanding direct lending mechanics allows elite investors to capture institutional yields away from volatile public exchanges. Direct lending desks originate custom corporate loans backed by solid physical assets. Holding primary claims on corporate real estate, equipment, and cash flows minimizes downside investment risks effectively. Mezzanine debt structures combine loan safety with equity, upside opportunities strategically. Private credit funds structure subordinated debt instruments that compound high yield during corporate expansion phases. Corporate restructuring teams take control of distressed companies when loan covenants fail. Converting private debt into controlling equity positions allows alternative asset managers to capture prime corporate assets. Specialty finance companies fund niche asset classes, including commercial real estate and maritime logistics. Direct private financing yields predictable cash flows, independent of broad stock market sentiment. Private equity firms partner directly with credit cartels to finance large-scale corporate acquisitions. Seamless capital integration between debt and equity desks accelerates major industry consolidation globally. Distressed debt funds accumulate troubled corporate loans at steep discounts during market panics. Restructuring operational mechanics unlocks massive capital value once broader economic conditions recover fully. Regulatory exemptions allow private debt funds to operate with high operational discretion. Operating without public reporting mandates keeps loan terms, yields, and portfolio compositions completely confidential. Variable rate loan structures protect private credit portfolios from rising interest rate environments. Adjusting interest yields dynamically ensures real capital preservation during broad inflation spikes globally. Unitranche financing structures blend senior and subordinated debt into single, streamlined loan facilities. Simplifying debt capital stacks reduces deal execution time for major private equity acquisitions. Discrete credit committees evaluate borrower cash flows, asset collateral, and management competence rigorously. Strict risk underwriting standards ensure capital deployment remains protected across volatile market cycles. Liquidity lockup agreements restrict investor withdrawals for long periods within private credit funds. Patient capital structures allow fund managers to execute multi-year corporate workouts without panic selling. Secondary credit markets allow alternative asset managers to trade private debt tranches discreetly. Selling loan portions to institutional partners rebalances portfolio risk while maintaining primary borrower relationships. Asset-backed private lending utilizes physical inventory, intellectual property, and receivables as collateral. Multi-layered asset security shields private credit cartels from catastrophic operational borrower losses. Macroeconomic stress testing models evaluate private debt portfolio resilience under severe recession scenarios. Proactive risk management ensures loan portfolios remain fully solvent during systemic economic shocks. Sovereign wealth funds allocate massive capital into private credit platforms for reliable long-term yield. Partnering with elite direct lenders grants sovereign wealth access to premium private corporate deals. Confidentiality covenants protect all private credit terms, interest rates, and fee structures strictly. Keeping loan agreements private prevents competitors from analyzing underlying corporate capital structures. Adopting private credit principles is essential for modern institutional yield strategies today. Positioning capital within senior secured debt frameworks protects asset value while securing consistent cash flow. Lobbying organizations protect shadow banking frameworks from restrictive financial regulation updates legally. Preserving private market flexibility allows alternative lenders to expand corporate market share continuously. Private credit syndicates pool capital across multiple elite funds to finance massive infrastructure deals. Co-lending arrangements distribute single borrower concentration risk across major global financial players smoothly. After-hours capital allocation sweeps automatically rebalance uninvested debt, fund cash into overnight instruments. Maximizing capital efficiency ensures zero investor funds remain idle within private credit accounts. Ultimate investment authority rests with senior credit committees composed of veteran financial directors. Strategic risk assessments guide multi-billion-dollar capital deployments across diverse international corporate sectors. Jurisdictional structuring of private credit vehicles optimizes tax efficiency for international institutional investors. Utilizing tax-neutral jurisdictions prevents fiscal leakage, accelerating long-term compound portfolio growth. Subterranean vault facilities store physical loan originations, collateral deeds, and personal guarantees safely. Physical documentation backups ensure legal enforceability stands, even during digital banking disruption events. Debt-for-equity swap provisions allow private credit funds to acquire equity control seamlessly during workouts. Taking equity ownership converts troubled loans into massive long-term capital gains opportunities. Exclusive private dining clubs facilitate deal syndication discussions between top credit fund managing directors. Strong institutional relationships grant member funds early participation rights in high-yield debt deals. Tier 1 private bank custodial accounts settle daily private loan interest and principal repayments securely. Multi-bank custodial frameworks prevent counterparty risk from compromising private credit fund liquidity. Credit intelligence units monitor real-time corporate borrower financial metrics to detect early stress. Proactive intervention allows loan managers to enforce covenant remedies before default events materialize. Real estate private credit funds finance commercial property developments through senior secured bridge loans. Securing prime real estate collateral ensures high recovery values during property market downturns. Antitrust legal counsels review private credit market concentrations to ensure long-term regulatory compliance. Strategic deal structuring allows continuous credit expansion without triggering formal antitrust regulatory investigations. Armored logistics couriers transport confidential debt execution documents between private international financial centers. Secure physical transport maintains complete privacy during sensitive, high-value corporate financing transactions. Strategic alliances between private credit platforms and investment banks create continuous deal flow pipelines. Sourcing proprietary deals grants private debt funds exclusive access to high-margin corporate borrowers. Real-time credit monitoring dashboards track portfolio leverage, interest coverage ratios, and cash flows live. Risk managers execute tactical hedges immediately when borrower metrics breach conservative internal thresholds. Private bank lounges in New York, London, and Singapore host confidential debt syndication meetings. Face-to-face negotiations ensure sensitive corporate financing terms remain completely protected from public disclosure. The private credit blueprint relies on senior secured positioning, strict loan covenants, and disciplined underwriting. Mastering these structural mechanics allows elite lenders to generate superior returns across cycles. As traditional bank lending contracts, private credit becomes the primary engine for corporate capital expansion. Positioning your portfolio alongside shadow banking cartels secures reliable high-yield returns. Building lasting institutional wealth requires shifting from public equities to senior secured private credit control. Mastering direct lending mechanics ensures your private capital remains protected and productive forever.